What's up everybody, it's Ace, and welcome back to the channel. Now listen up, because in this video we're diving deep into the world of investing, specifically for all you beginners out there. Whether you've got a few $100 or a few thousand to invest, these tips are going to help you get started on the right track. We're going to break down some seriously important concepts, talk about how to avoid common mistakes, and by the end of this video, you'll be well on your way to building wealth and crushing your financial goals. Let's do this! Alright, so before you even think about putting your money into anything, you gotta ask yourself, what am I actually trying to achieve here? Are you saving for a down payment on a house? Planning for early retirement? Maybe you just want to grow your wealth over the long term. Defining your financial goals is absolutely crucial because it's gonna shape your entire investment strategy. Think of it like this. You wouldn't just hop in your car and start driving without knowing where you're going, right? The same goes for investing. Once you have a clear destination in mind, whether it's that dream house, financial freedom, or a comfortable retirement, you can start mapping out the best route to get there. This means figuring out how much you need to invest, what kind of returns you'll need to reach your goal, and how much risk you're comfortable taking on. Trust me, putting in the time to define your goals up front is going to save you a ton of headaches and potential detours down the road. Now let's talk about diversification. You've probably heard the saying, don't put all your eggs in one basket. Well, in the world of investing, this is basically the golden rule. Diversification means spreading your money across different types of investments like stocks, bonds, real estate, and maybe even some alternative assets like cryptocurrency. Why is this so important? Because different asset classes perform differently under different market conditions. When one investment might be down, another might be up, which helps to balance out your overall portfolio and reduce your risk. Imagine putting all your money into a single stock, and then that company goes bankrupt. You'd lose everything. But if you had diversified your portfolio, even if one investment takes a hit, the others can help cushion the blow. Remember, diversification is your best friend when it comes to managing risk and protecting your hard-earned money. Chapter 3. The Stock Market. Your guide to how it works. Okay, so the stock market. It might seem intimidating at first, but understanding the basics is essential for any investor. Basically, the stock market is where companies go to raise money by selling shares of ownership, also known as stocks. When you buy a stock, you're essentially buying a tiny piece of that company. The price of a stock fluctuates based on supply and demand. If more people want to buy a stock, the price goes up, and if more people want to sell, the price goes down. Now, there are two main ways to make money in the stock market. First, you can buy low and sell high, which is called capital appreciation. Second, some companies pay out a portion of their profits to shareholders in the form of dividends. The stock market can be volatile in the short term, but over the long term, it has historically trended upwards. That's why it's so important to have a long-term perspective when it comes to investing in stocks. Chapter 4. Invest in what you know. Stick to your expertise. Have you ever heard the saying, invest in what you know? Well, there's a reason why this advice has stood the test of time. When you invest in companies or industries that you're already familiar with, you have a much better understanding of their products, their competition, and their overall potential for growth. Plus, it's just way more interesting to follow companies that you're genuinely passionate about. Let's say you're a tech enthusiast who's always on the cutting edge of the latest gadgets. Investing in tech companies might be a natural fit for you because you're already plugged into that world. Or maybe you're a coffee connoisseur who can't start your day without a perfectly brewed cup. Investing in coffee companies or even coffee bean futures might be something to explore. Remember, investing doesn't have to be boring. Tap into your interests, do your research, and choose companies that you believe in. Chapter 5. Fees and expenses. The silent killers of your returns. Listen up, because this is a big one. Fees and expenses might seem like small potatoes, but trust me, they can eat into your returns over the long run. Every time you buy or sell an investment, there's usually a commission fee involved. And if you're investing in mutual funds or ETFs, there are also annual expense ratios that you need to pay. These fees might seem small, maybe a fraction of a percent here and there, but over time, they can really add up. Let's say you invest $10,000 and earn an average annual return of 7%. After 30 years, you'd have over $76,000. But if you factor in a 1% annual fee, your returns would be reduced to just over $57,000. That's a difference of almost $20,000. The bottom line is this: be mindful of fees and expenses, and always look for low-cost investment options whenever possible. Outro: start investing today. So there you have it, guys. 5 essential investing tips to help you get started on the right foot. Remember, investing is a marathon, not a sprint, and the key is to start early, stay consistent, and never stop learning. The more you know about investing, the more confident you'll become in making smart decisions for your financial future. Now get out there and start investing in yourself and your future. Thanks for watching. If you found these tips helpful, don't forget to like, subscribe, and hit the notification bell for more investing advice. Happy investing.